Welcome to Chapter 4, where we'll dive into the fundamentals of job costing. This chapter will introduce you to how organizations assign, track, and evaluate costs within a typical job costing system. We'll explore key concepts related to costing and look at the differences between job costing and process costing. Additionally, we'll cover standard costing methods and how costs flow through the accounting system. Understanding these basics is crucial for effectively managing and controlling costs on specific jobs or projects. Let's begin by defining what job costing is and why it's important. In this chapter, we focus on the fundamental components of costing systems. To begin, every costing system must clearly define what is being costed, how costs are collected, and how shared or indirect costs are assigned. The term cost object refers to anything for which we want to measure costs separately. This could be a specific job, a product, a service, or even a customer. Next, cost accumulation is the way we gather and organize those costs before we assign them. Typically, this involves tracing direct materials, labor, and overhead costs. Then, we have cost allocation, which comes into play when assigning indirect costs. Since these costs can't be traced directly to a specific cost object, we allocate them using a logical base, like labor hours or machine hours. Understanding these building blocks, cost objects, cost accumulation, and cost allocation, is crucial for developing accurate and effective costing systems. Job costing is one common application where we track costs for individual jobs to better manage expenses and profitability. In this chapter, we're focusing on the differences between job costing and process costing, two important systems used to track costs in different production environments. Job costing is ideal for custom products or services where costs are tracked for each specific job or batch. This means we carefully trace materials, labor, and overhead directly to the particular work being done, allowing precise cost control for unique projects. On the other hand, process costing suits mass production scenarios where large volumes of similar products flow continuously through departments or processes. Instead of tracking costs for individual jobs, costs are averaged over all units, which simplifies accounting when products are indistinguishable and produced in bulk. Understanding these distinctions helps us choose the right costing method based on the production setup and ensures accurate cost allocation. Now, let's talk about when to use job costing. Job costing is most effective when each project or assignment is unique, easily identifiable, and its cost can be directly traced back to the specific resources it uses. For example, consulting projects often fit this model because they have client-specific hours and deliverables that need to be tracked individually. Custom furniture is another good example. Each piece is built to unique designs and materials, so costs vary from one job to another. Construction contracts also benefit from job costing since labor, materials, and overhead can differ significantly depending on the specific project. Finally, specialized services like repairs, design work, or custom installations are ideal candidates because they require careful tracking of the resources applied to each individual job. Essentially, job costing lets you assign costs precisely, helping you gauge profitability for each distinct project. Now let's talk about when it's best to use process costing. This method works really well for high-volume, uniform output, where products are pretty much identical. For example, chemical manufacturing often involves continuous batches, making it a great fit. Similarly, food products that go through repeated processing stages can benefit from process costing, as can beverages that have standardized filling and packaging processes. Even petrochemicals, which are refined in continuous flow operations, are perfect candidates for this approach. In contrast, job costing is used for more customized, unique jobs, but here we focus on the scenarios where process costing shines. In this section, we're going to focus on the key difference between direct and indirect costs. Direct costs are those expenses that we can trace directly to a specific job or project. For example, the materials used exclusively in Job 101, the wages paid to workers dedicated to a custom project, or special parts purchased for a particular customer order. These costs are straightforward to assign because they clearly belong to one cost object. On the other hand, indirect costs are a bit more complex. These are expenses that support multiple jobs or projects and can't be traced easily to a single one. Instead, we allocate these costs based on cost pools or allocation bases. Examples include factory rent, utilities, salaries of supervisors who oversee various jobs, and depreciation on equipment that's used across multiple production tasks. Understanding this distinction is critical because it affects how we handle costing in job costing systems and ensures we accurately attribute expenses to the proper jobs or products. Now, let's dive into the different cost accumulation methods. First, we have actual costing. This method records costs exactly as they happen, using the actual expenses incurred for all cost elements. It gives an accurate picture but can be complex to track in real time. Next is normal costing. This method combines actual direct costs with overhead applied using budgeted or predetermined rates. It helps smooth out overhead costs by using estimates rather than waiting for actual overhead figures. Finally, standard costing uses predetermined standard costs for all elements, including materials, labor, and overhead. This approach simplifies cost tracking and makes it easier to identify variances between expected and actual costs. Understanding these methods is key to choosing the right approach for job costing, ensuring accurate and efficient cost management. In this chapter, we're comparing two important costing systems, actual costing and standard costing. Both serve different needs but revolve around one key question: do we record what actually happened, or do we manage against what should happen? Let's start with actual costing. This method uses actual costs for materials, labor, and overhead. The full cost is only known once the work is completed, making it great for providing precise historical data on what a job truly cost. On the other hand, standard costing relies on predetermined quantities, rates, and overhead benchmarks. It provides expected costs before and during production, which is very useful for planning, control, and analyzing variances from target costs. So, while actual costing gives us accuracy after the fact, standard costing helps us manage and control costs proactively. Both systems have their place depending on whether you want exact historical cost data or a tool to guide and monitor performance. In this chapter, we focus on the 7-step costing approach, which provides a clear sequence for moving from identifying what is being costed to how overhead is assigned. First, we identify the cost object. This means defining the specific job, product, service, or customer that we want to measure costs for. Next, we determine the costs involved by figuring out which resources this cost object consumes. Once we have that, we classify costs by separating direct costs, which can be traced directly to the cost object, from indirect costs, which cannot. Then, we calculate the total cost by summing all the direct costs associated with the job or output. After that, we determine the cost allocation base. This is the activity or factor that links the overhead costs to the cost object in a meaningful way. Following this, we identify cost pools, which means grouping together indirect costs that will be allocated using the same method. Finally, we allocate these costs by applying overhead from each cost pool to the cost object using the chosen allocation base. This structured approach ensures accurate and logical costing, which is key in job costing systems. The first step in job costing is to identify the cost object. Essentially, we need to determine exactly what we are costing. Once we know the cost object, we categorize the associated costs into two groups, those that can be directly traced to the object, and those that must be assigned indirectly. For example, if the cost object is a custom home, direct costs would include lumber, concrete, and carpenter labor, while indirect costs might cover equipment depreciation. In a print job, direct costs would be the paper, ink, and press operator's time, whereas factory utilities would be an indirect cost. Similarly, for a repair order, replacement parts and technician hours are direct costs, while shop supervision is an indirect cost. Understanding how to properly classify these costs is crucial because it impacts the accuracy of the job costing and ultimately helps in making better financial decisions. This step lays the foundation for all subsequent calculations in job costing. Now, let's dive into steps 3 and 4, where we classify and calculate costs. First, we start with categorizing costs into direct and indirect. Direct costs are those that can be traced directly to a specific job, such as direct materials and direct labor. For example, the wood and labor hours used to build a piece of furniture are direct costs. On the other hand, indirect costs are shared across multiple jobs and can't be traced to a single one directly. These include things like utilities and supervision, which we allocate as manufacturing overhead. To calculate the total job cost, we add up the direct materials, direct labor, and the applied manufacturing overhead. Take job 145 as an example. The direct materials cost $4,800, direct labor was $3,200, and the applied overhead amounted to $2,400. Adding these together, the total cost for the job is $10,400. So, the key formula to remember here is that job cost equals direct materials plus direct labor plus applied overhead. This classification framework helps us ensure accurate costing by clearly separating direct and indirect expenses and assigning them properly. Now, let's dive into steps 5 and 6, which focus on determining the allocation base and cost pools. The allocation base is essentially the factor we use to assign indirect costs to different jobs. It's important because it reflects how each job uses resources. Common examples include machine hours, direct labor hours, labor cost, or the number of units processed. Next, we have cost pools. These group together similar indirect costs before we allocate them using the chosen allocation base. For instance, manufacturing overhead includes indirect materials, indirect labor, factory utilities, and depreciation. Support costs, on the other hand, encompass expenses like setup, maintenance, supervision, and material handling. These grouped costs are then allocated using a single chosen base, applying the cost pool to each job according to the activity measure that best matches how the resources are consumed. This approach helps ensure more accurate job costing by linking costs directly to the activities that generate them. Now, let's walk through the process of allocating overhead costs using a practical example. We start with the total manufacturing overhead cost pool, which is $240,000. This represents all the indirect costs we need to distribute. Our allocation base is estimated machine hours, totaling 12,000 hours. To find the overhead rate, we divide the total overhead cost by the total machine hours, giving us $20 per machine hour. With this rate in hand, we can then allocate overhead to specific jobs based on their machine hour usage. For instance, Job A used 150 machine hours. Multiplying these hours by the overhead rate of $20 per hour, Job A receives $3,000 in allocated overhead. This calculation ensures that overhead costs are fairly assigned according to actual usage, following the formula, allocated overhead equals cost pool divided by allocation base, multiplied by usage. This framework is fundamental in job costing because it helps us assign indirect costs accurately, ensuring better cost control and pricing decisions. In job costing, costs flow through inventory accounts in a specific sequence before the job is ultimately sold. It begins with raw materials, which are purchased and recorded in the system before being issued to production. As the job progresses, direct materials, direct labor, and allocated overhead are assigned to specific jobs and recorded in the work-in-process account. Once the job is completed, its total costs move from work-in-process to finished goods inventory, where they wait until the job is sold. Finally, when the job is sold, the accumulated costs transfer from finished goods to cost of goods sold, becoming an expense on the income statement. This clear tracking system ensures accurate cost measurement at each stage of production. In this chapter, we focus on the journal entries involved in job costing, which are essential for tracking the flow of costs through production. There are three main types of entries to consider: materials, labor, and applied overhead. First, we record material purchases. When raw materials are acquired for future use, we debit the raw materials control account and credit accounts payable. This recognizes both direct and indirect materials needed for production. Next is labor allocation. Factory payroll is divided between direct labor, which is charged to work in process control, and indirect labor, which goes to manufacturing overhead control. The corresponding credit is made to wages payable. Finally, overhead allocation applies manufacturing overhead to jobs using a predetermined overhead rate. We debit work in process control and credit manufacturing overhead allocated. This step ensures each job absorbs a fair share of overhead costs. Together, these journal entries provide a clear, systematic way to track costs as they enter and move through the production process in job costing. In this slide, we focus on the key distinctions between actual and allocated manufacturing overhead. Actual manufacturing overhead includes all the indirect costs that accumulate during production, such as indirect materials, indirect labor, utilities, and depreciation. These costs are recorded as they occur throughout the period. On the other hand, allocated manufacturing overhead is the amount applied to jobs using predetermined rates before the actual costs are fully known. This allocation is based on an allocation base like direct labor hours, machine hours, or direct labor cost, giving us a systematic way to assign overhead to different jobs. At the end of the year, we compare the actual overhead costs with the allocated overhead. Any difference between these two amounts results in either underallocated or overallocated overhead. Understanding this gap is crucial because it affects the accuracy of job costing and helps us adjust expenses for more precise financial reporting. Now, let's talk about over and underallocated overhead. This happens when we compare the manufacturing overhead that we allocated throughout the year with the actual overhead costs incurred. If the allocated overhead is greater than the actual, we call this overallocated overhead, meaning we assign too much overhead. As a result, we need to reduce the costs to reflect the true expense. On the other hand, if the allocated overhead exactly matches the actual costs, we have a balanced situation, and no adjustment is necessary at year-end. Finally, if the allocated overhead is less than the actual overhead, that's underallocated overhead, indicating we assign too little overhead, so we need to increase the costs to make up for the difference. Understanding these scenarios helps ensure our cost accounting is accurate and reliable. In this slide, we're focusing on the proration method for adjusting year-end overhead. Essentially, this method allocates any under or overallocated overhead across three accounts: work in process, finished goods, and cost of goods sold, based on their ending balances. Let's break down the example here. We have an underallocated manufacturing overhead of $30,000 that we need to distribute. The ending balances for WIP, finished goods, and COGS are $60,000, $90,000, and $150,000 respectively. We calculate each account's share of the total balance. WIP represents 20% of the total, finished goods 30%, and COGS 50%. To allocate the overhead, we multiply these percentages by the $30,000 underallocated overhead. For WIP, 20% of $30,000 gives us $6,000. For finished goods, 30% results in $9,000, and for COGS, 50% results in $15,000. After adding these amounts, the adjusted balances become $66,000 for WIP, $99,000 for finished goods, and $165,000 for COGS. It's important to note, if the overhead were overallocated, we would subtract these prorated amounts instead of adding them. This method ensures a fair proportionate adjustment reflecting the actual overhead costs remaining in inventory and those expensed. Now, let's discuss the write-off method for adjusting year-end overhead. This method involves closing the entire under- or overallocated manufacturing overhead variance directly to cost of goods sold. It's most effective when the variance is immaterial or when cost of goods sold makes up the bulk of the year-end allocation base. The adjustment itself is straightforward. If overhead is underapplied, we debit cost of goods sold and credit manufacturing overhead. Conversely, if overhead is overapplied, we reverse this entry by debiting manufacturing overhead and crediting cost of goods sold. Essentially, this method simplifies the year-end correction by moving the variance in total to cost of goods sold, ensuring our financials reflect the actual overhead costs accurately. In this chapter, we focus on the year-end overhead adjustment using a combination method. This hybrid approach involves allocating the material portion of the overhead variance across key accounts like work in process, finished goods, and cost of goods sold. For any small residual amount that remains, we simply write it off directly to cost of goods sold. The decision to prorate is based on whether the variance is material. If it is, we spread the adjustment to improve accuracy where it matters most. If the leftover amount is immaterial, writing it off keeps things simpler and avoids unnecessary complexity. Why does this method work well? It strikes a balance. It enhances precision for the significant dollar amounts without the burden of prorating every minor difference. For example, if there's a $20,000 underallocated overhead, $16,000 might be prorated across accounts, while the remaining $4,000 is written off directly to cost of goods sold. In a typical allocation, that $16,000 might be split as $6,000 to work in process, $5,000 to finished goods, and $5,000 to cost of goods sold. The $4,000 write-off straight to cost of goods sold keeps the process efficient without sacrificing meaningful accuracy. This method is especially useful in job costing environments where careful tracking of overhead is essential. In this chapter, we explore the different variations of standard costing and how it evolves to meet organizational needs. Standard costing is not a one-size-fits-all approach. It adapts to provide better control, a better fit to specific operational contexts, and deeper insights into overhead costs. One important variation is variance analysis, which is a tool for comparing standard costs to actual results. This helps us pinpoint where materials, labor, or overhead costs deviate from expectations, allowing for timely corrective actions. Flexible budgets are another adaptation. They adjust budgeted costs based on the actual level of activity, which makes performance comparisons much more relevant and insightful. Sometimes a single cost driver is insufficient to explain overhead consumption accurately. In those cases, multiple cost drivers are used to allocate costs more precisely, reflecting the complexity of operations. Activity-based costing takes this even further by assigning overhead costs to specific activities. This approach provides a more detailed and accurate picture of product or job costs. Lastly, job costing focuses on tracking costs by individual jobs, which is especially useful in industries where products or services are customized. Together, these variations help organizations manage costs more effectively by tailoring standard costing methods to their unique requirements. Now, let's dive into Chapter 4, which focuses on activity-based costing, or ABC. Unlike traditional costing methods that use a single broad allocation base for overhead, ABC assigns overhead costs through multiple activity cost drivers. This means that specific activities like setups, inspections, moves, and support work are traced individually, allowing for a much more precise allocation of overhead. As a result, ABC provides a more accurate reflection of the true overhead costs associated with products, services, or customers. Another key benefit is that it helps identify non-value-added activities, those that don't contribute to customer value, so managers can target them for reduction or elimination, improving overall efficiency. This approach significantly enhances job costing by connecting costs more directly to the activities that generate them. In implementing a job costing system, it's crucial to build it step by step to ensure reliable and accurate cost tracking from the very beginning. The first step is defining the chart of accounts. This means setting up clear, distinct accounts for direct materials, direct labor, overhead, work in process, and finished goods, so costs are categorized properly. Next, we establish the cost object structure. This involves assigning unique job numbers and standard fields to every job, making sure we can trace each cost directly to its job without confusion. The third step is implementing cost tracking procedures. We need to document exactly how materials, labor time, and overhead are recorded, reviewed, and approved. This standardization is key to maintaining consistency and accuracy. Fourth, training personnel is essential. Employees must understand the coding rules, the timing for data entry, and why accurate job data matters. Their involvement and understanding directly impact the system's effectiveness. Finally, integrating the job cost system with financial systems ensures that job cost records link seamlessly to the general ledger and reporting processes. This integration keeps operational data and accounting aligned, preserving accuracy across the board. By following these 5 steps carefully, we lay a solid foundation for a job costing system that delivers precise and timely cost information. When evaluating a job costing system, it's important to remember that simply having detailed information isn't enough. The system must actually help managers make better decisions. First, accuracy is key. Does the system reflect the true costs of each job with reasonable precision? Without accurate data, decisions could be misguided. Next, timeliness matters. How quickly does cost information become available for managers to act on? Delays can reduce the usefulness of the data. Then, there's the cost-benefit aspect. Does the improved information justify the expense of maintaining the system? Finally, usability is crucial. Even the most accurate and timely data won't help if managers don't understand the reports or choose not to use them. A good job costing system balances all these factors to provide meaningful insights that drive better business outcomes. Now, let's talk about some common pitfalls in job costing that can really affect the accuracy and usefulness of the data. First, using inaccurate allocation bases can be a big problem. This means that jobs might end up absorbing overhead costs in the wrong proportions, which throws off the entire cost picture. Next, when cost pools are overly complex, the system becomes difficult to manage. It slows down processes and increases costs, making it less efficient overall. Another issue is inadequate overhead rates. If these rates are outdated, they can cause constant under- or overallocation of costs, leading to unreliable job costing results. Finally, poor data capture, like missing labor or material records, distorts the total job cost, which can make it hard to determine profitability or control costs effectively. These pitfalls highlight the importance of maintaining clear, accurate, and streamlined job costing processes. Here, we're looking at a real-world job costing example for a custom office redesign, identified as Job 247. The direct materials used for this job, which include fixtures, flooring, and finish materials, amount to $18,000. The direct labor cost, covering design, installation, and site supervision, is $12,000. Manufacturing overhead is applied at a rate of 150% of the direct labor cost. So, in this case, the overhead applied is $18,000, calculated as 150% times $12,000. Adding these components together, materials, labor, and applied overhead, gives us the total job cost of $48,000. This example clearly illustrates how each cost element contributes to the final total in job costing. To sum up Chapter 4, there are several key takeaways to remember. First, building block concepts are the foundation for designing any costing system, ensuring consistency and reliability. Next, choosing between job costing and process costing really depends on the type of production environment you're dealing with, whether it's customized jobs or continuous processes. The 7-step approach we discussed provides a clear and systematic framework to guide costing accurately. Overhead allocation stands out as a critical component, and its success hinges on selecting the appropriate allocation base. It's also important to make year-end adjustments to reconcile the actual overhead costs with what was allocated throughout the year. Finally, modern costing methods like activity-based costing, or ABC, help improve accuracy, especially in complex operations where traditional methods might fall short. Keeping these points in mind will give you a solid grasp of costing systems and their practical applications.